How about counter-trend trading strategies in futures trading? This involves taking positions opposite to the prevailing trend in anticipation of a reversal. It's a riskier strategy as it goes against the market momentum, but can be profitable if timed correctly. What is the strategic goal of counter-trend trading strategies in the context of futures trading? The strategic goal of counter-trend trading strategies in futures trading is to capitalize on trend reversals. These strategies focus on identifying and trading against the prevailing market trend, aiming to profit from the points where the trend begins to reverse direction. The primary goal of counter-trend trading in futures is to profit from anticipated reversals in the prevailing market trend. This strategy is typically aimed at capital appreciation through speculation. Traders using this approach seek to identify potential turning points in the market, taking positions opposite to the current trend in expectation of a reversal. How do counter-trend trading strategies perform under various market conditions? Counter-trend trading strategies are ideal for potentially overextended markets where a current trend might be nearing its end. These strategies can be effective when a market shows signs of exhaustion after a prolonged trend, indicating a potential reversal. Counter-trend trading strategies are most effective in market conditions where a trend may be overextended and thus ripe for a reversal. This can occur in both volatile and trending markets. The strategy may be less effective in markets where trends are strong and show no signs of weakening, as the risk of misjudging the trend reversal is higher. What risk factors are involved in counter-trend trading strategies? There are higher risks involved in counter-trend trading strategies due to going against the market momentum. Predicting trend reversals can be challenging and carries the risk of entering trades prematurely if the prevailing trend continues longer than anticipated. Counter-trend trading is inherently riskier as it involves going against the prevailing market momentum. The primary risk is entering a trade too early before the trend actually reverses, which can lead to significant losses if the trend continues. Traders must have strict risk management practices, including tight stop-loss orders, to mitigate the potential losses from incorrectly timed entries. What are the potential rewards of employing counter-trend trading strategies? The potential rewards of employing counter-trend trading strategies come from profiting from the early detection of trend changes. If executed correctly, these strategies can yield significant profits by capturing the initial stages of a new trend. The reward potential in counter-trend trading lies in the ability to identify and capitalize on trend reversals before they become apparent to the majority of the market. The best-case scenario is accurately predicting a market top or bottom and entering a position that profits from the subsequent trend reversal. However, traders should understand that accurately timing reversals is challenging, and the average expected return can vary significantly based on market conditions and the trader's skill. What considerations should be taken into account when implementing counter-trend trading strategies in futures trading? Key considerations when implementing counter-trend trading strategies include accurately identifying reversals and effectively managing risks. This involves using technical and fundamental analysis to detect signs of a trend reversal and employing strict risk management techniques to minimize potential losses. Implementing a counter-trend trading strategy effectively involves Utilizing technical analysis tools such as oscillators like RSI or stochastics, divergence indicators, or reversal candlestick patterns to identify potential trend reversals. Carefully selecting entry points that signal a high probability of trend reversal while being aware of false signals. Setting precise stop-loss orders to manage the risk of the trend continuing against the position. Monitoring macroeconomic factors and market news that could influence trend stability and the likelihood of reversals. Being prepared for the psychological challenges of going against prevailing market sentiment and having the discipline to adhere to pre-planned entry and exit strategies. Counter-trend trading in futures requires a high level of market expertise, the ability to interpret technical signals accurately, and a strong risk management discipline. Traders should approach this strategy with caution, understanding its risks and rewards, and ensuring their trading style and risk tolerance align with the demands of counter-trend trading. Let's talk about volume analysis strategies in futures trading. Traders use volume data to identify potential trading opportunities. High volume can indicate the strength of a market move, either in a new trend or in a reversal. What are the objectives of volume analysis strategies in futures markets? The objectives of volume analysis strategies in futures markets are to utilize volume data to identify market moves. These strategies analyze trading volume as a primary indicator to confirm trends, detect reversals, or highlight the strength of market movements. The primary goal of employing volume analysis in futures trading is to utilize volume data as a key indicator for identifying potential trading opportunities. Traders use volume to gauge the strength and conviction behind market moves, whether they are initiating a new trend or indicating a possible reversal. This strategy is often used for both speculation and capital appreciation, as it provides insights into the momentum behind price movements. How suitable are volume analysis strategies for different market conditions? Volume analysis strategies are effective in both trending and reversal phases of the market. They can be used to confirm the continuation of a trend or to identify potential reversal points, making them versatile across various market conditions. Volume analysis strategies are versatile and can be effective in a variety of market conditions. High volume can signal the strength of a move in trending markets, confirming the sustainability of the trend. Similarly, in markets poised for reversal, an increase in volume can validate the potential change in direction. This strategy is particularly useful in volatile markets, where volume spikes can signify key trading points. What is the risk profile of volume analysis strategies? The risk profile of volume analysis strategies involves assessing the risks of misinterpreting volume signals. Misreading volume data or failing to corroborate volume signals with other indicators can lead to incorrect trading decisions and potential losses. The risk in volume analysis lies in the potential misinterpretation of volume signals. High volume does not always equate to a sustainable market move. It can sometimes be a result of temporary factors. There is also the risk of the market moving against the position if the volume analysis was based on incomplete or misleading data. It is essential to use comprehensive risk management strategies to mitigate potential losses. What rewards can be expected from volume analysis strategies? Rewards from volume analysis strategies can be gained from the accurate interpretation of volume trends. Correctly analyzing how volume correlates with price movements can provide valuable insights into market dynamics, leading to profitable trading opportunities. The reward potential in volume analysis comes from the successful interpretation of volume trends and acting on these signals before the majority of the market does. The best case scenario involves correctly identifying high volume movements that lead to significant price changes, allowing for profitable trades. However, traders should maintain realistic expectations, as not every high volume signal will result in a profitable market move. What are the key steps for implementing volume analysis strategies in futures trading? Key steps for implementing volume analysis strategies in futures trading include applying volume analysis in conjunction with other technical analysis tools. This involves understanding how volume changes relate to price movements, using volume indicators like the volume oscillator or on-balance volume, otherwise known as OBV, and integrating this analysis into a broader trading strategy. Implementing a volume analysis strategy effectively in futures trading includes monitoring volume patterns alongside price movements using tools like volume bars or volume weighted average price, simply known as VWAP. Identifying significant increases or decreases in volume that may signal the start of a new trend or a potential reversal. Correlating volume data with other technical indicators for a more comprehensive market analysis. Setting up trades based on volume signals with clear entry and exit points, as well as predetermined stop-loss orders. Considering the impact of external factors like economic reports or market news, which can influence trading volume. Being aware of the contract's liquidity and the specific characteristics of the futures market being traded. Volume analysis in futures trading requires a nuanced understanding of market dynamics and the ability to interpret complex data sets. Traders employing this strategy should have a keen eye for detail and be adept at correlating volume data with other market indicators to make informed trading decisions. Let's talk about news and economic data trading strategies in futures trading. Involves trading based on news and economic reports that have the potential to cause significant market movements. Traders must be very quick to react, as the market's response to news can be immediate and volatile. What is the primary objective of news and economic data trading strategies in futures trading? The primary objective of news and economic data trading strategies in futures trading is to capitalize on market movements triggered by news events. These strategies aim to take advantage of the volatility and price fluctuations that often follow major news releases or economic data announcements. The primary objective of trading based on news and economic data in futures markets is to capitalize on the significant market movements that these events can trigger. This strategy is often oriented towards speculation and capital appreciation, as traders aim to leverage the immediate market response to news releases for potential gains. How do news and economic data trading strategies adapt to different market conditions? News and economic data trading strategies are highly effective in volatile and news-sensitive markets. They are particularly suitable for periods when markets are highly reactive to economic reports, geopolitical events, or any significant news that can impact market sentiment and prices. This strategy is particularly effective in volatile markets that are sensitive to news and economic data. Markets that react strongly to geopolitical events, economic reports, and corporate news provide fertile ground for this strategy. It is less effective in markets where such news has a muted impact or is already priced in. What is the risk profile associated with news and economic data trading strategies? The risk profile associated with news and economic data trading strategies involves navigating the risks of rapid and unpredictable market reactions. Markets can respond quickly and dramatically to news, and there is a risk that market movements may not align with initial expectations based on the news. The key risk in news and economic data trading is the market's rapid and sometimes unpredictable reaction to news, which can lead to significant price volatility. There is a risk of the market moving against the position if the news interpretation is incorrect or if market sentiment shifts unexpectedly. Quick reaction times and a solid understanding of market sentiment are essential to manage these risks effectively. What potential rewards can be expected from news and economic day trading strategies? The potential rewards from news and economic data trading strategies come from profiting from the accurate anticipation of news impact. If a trader correctly predicts how the market will react to a news event, they can position themselves to capitalize on the resulting market movements. The reward potential in this strategy lies in accurately anticipating the market's reaction to news and entering trades that align with this reaction. The best case scenario is a well-timed entry just before the news release, capitalizing on the immediate market movement. However, traders should be aware of the average expected returns and the fact that not all news will result in profitable opportunities. What are the key steps and considerations in implementing news and economic data trading strategies in futures trading? Key steps and considerations in implementing news and economic data trading strategies include effective execution of news-based trades. This involves staying informed about upcoming news events, understanding the potential market impact of different types of news, and executing trades quickly and efficiently in response to news releases. Implementing a news and economic data trading strategy involves staying informed about upcoming economic reports, news events, and geopolitical developments that could impact the markets. Using resources like economic calendars to track important release dates and times. Analyzing pre-release market sentiment and positioning to gauge potential market reactions. Quickly interpreting news outcomes and executing trades in response to the actual data versus market expectations. Setting predefined entry and exit points along with stop-loss orders to manage the high volatility and fast-paced nature of news-based trading. Being aware of factors like liquidity and the specific characteristics of the futures contract being traded. Trading based on news and economic data in futures markets requires traders to be well informed, quick to react, and adept at interpreting both the news and the market's response to it. A successful trader in this domain is one who can combine rapid execution with a keen understanding of market dynamics and sentiment. Let's discuss pivot points strategies in futures trading. Using pivot point calculations based on the previous day's high, low, and closing prices to identify potential support and resistance levels for the current day's trading. What is the strategic goal of pivot points strategies in the context of futures trading? The strategic goal of pivot points strategies in futures trading is identifying key trading levels for decision making. Pivot points are used to determine critical support and resistance levels, which can guide traders in making entry and exit decisions. The primary objective of using pivot points in futures trading is to identify potential support and resistance levels based on the previous day's trading data. This strategy is typically used for short-term decision making, aiding in speculation and capital appreciation. By understanding these levels, traders can align their trading strategies with the market's potential movement for the current day.